Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion, and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion today, we want to say thanks for questions coming from our audience at SmithWeekly, including Robert B., Paul M., Jack T., and Matt S. We have a new guest on the program today. Mr. Brad Docherty is with us on the program. Brad is the president, CEO, and chairman of Source Rock Royalties, a Western Canada-focused oil and gas royalty company that has revenue-generating royalty streams on producing operations in Alberta, as well as Saskatchewan, that allow the company to reinvest on growth initiatives as well as pay steady dividends to shareholders. The company is based in Calgary, Alberta. Source Rock Royalties is listed on the Toronto Venture Exchange under the symbol SRR. Brad, thank you for coming on the podcast. Welcome.
Andrew, thanks for having me.
To get started here, Brad, I'd like to have you, of course, as customary, you're a new guest. Tell the audience a little bit about your background and experience in the junior natural resource sector.
Yeah, absolutely. So my background, it really started as a corporate finance lawyer based in Calgary. I was working for various smaller companies that were engaged in either upstream oil and gas or somehow connected to the industry through their business in an indirect way. And so I was really exposed to various aspects of the oil and gas industry, and from that, derived an interest in figuring out ways to build a business that could be scalable and sustainable. And really that led me to discovering the concept of oil and gas royalties, and then being really intrigued by the ability to purchase assets, own assets in a simple way, and then build a business that can be sustainably cash flow positive and really scale over the long term to drive free cash flow through the royalty structure.
Well, we don't have too many oil and gas royalty folks on our program, so it's good to hear from a company on this end, as well as, of course, the angle of a royalty company, of which the royalty industry plays an important role in the natural resource sector. And with that, Brad, with your view of a royalty company in the sector, how do you look at the oil markets today? When you look out there and you look at the land of junior companies, production companies, exploration companies, how do you see the conditions out there from the perspective of course, a royalty company, which is going to be a different perspective and probably one that's quite healthy to have? What do you see out there on sentiment? How do you look at the market now shaping up into 2025 from the perspective of your office?
I think it's important to point out, first of all, that our perspective does differ from an operator, given that as a royalty owner only, we have no ongoing costs associated with drilling wells on our assets. We have no long-term liabilities associated with the wellbores on our assets. And so, we are really looking at the industry conditions from a bit of a different perspective. And so, that for us, though, is important to make sure that our counterparty operators are well positioned in the industry. And, generally speaking, Canadian oil and gas companies are quite well positioned these days, even the junior operators. That has fallen out of the ups and downs over the last 12 years. And we, I say 12 years because we've been building this business for 12 years. And over that time, we've seen 4 oil price crashes. And during those oil price crashes, that has weeded out a lot of the business models and companies that were, not sustainable over the long term from the operator standpoint. And so, we now see a landscape in Canadian oil and gas that is extremely healthy. Oil prices today, let's call it $65 to $70 WTI US dollar prices. With the FX dynamic, the Canadian dollar being weak, that has got the industry set up where price realization in Canada is quite strong, and that has allowed these companies over time here to really have clean balance sheets and position themselves for sustainable growth, modest growth going forward. Now, having said that, the growth element of the business in Canada is a little bit more focused on the higher end of the market, where you've got bigger companies that are kind of driving the growth wedge. I would say the smaller company side of the industry, is figuring out how to put together high quality assets in a cost effective way, and then develop those assets in a cost effective way, given a lot of inflationary pressures on the business. But the positive of what I'm saying here is that these companies are building themselves and creating modest growth in a prudent manner. Debt has largely become unavailable to the junior segment of the oil and gas industry in Canada. Equity valuations are quite low, and so access to equity has been a challenging environment for a while. And so these companies are having to operate extremely prudently. And so, you're not seeing a big, robust growth wedge coming out of the junior side of the industry. Prudence is key, and prudence is there. The industry is growing. Balance sheets are healthy. And again, companies are focused on having strong cash flow profiles, and then, kind of having a focused strategy instead of just buying anything they can buy and building, a bulked up business that then has balance sheet weakness. And I would see that continuing into 2025. I think prudence at the company level is going to be key across the industry. I think you're going to see modest growth from a production standpoint on the oil side of the market, and really companies trying to drive returns to shareholders, and really kind of make sure that they're protected from any potential downturn by not kind of levering up or doing something that is stretching their balance sheet capabilities.
Brad, thank you for that. How do you look at the conditions broadly for oil specifically, Brad? Because this is obviously where most of the company's income comes from, rather than gas. But give us a little bit of a flavor in terms of if there was further declines in oil prices. With that, I suppose, is it even likely that those declines would be sustainable for any mid to long-term case, which I would probably suggest, given the global conditions out there, the answer to that is no. But also on this basis, even with FX differences, obviously in favor of selling oil in US dollars, having production costs in Canadian dollars, what do you see from a Canada standpoint as really a break-even point for it to make sense to continue production operations? Obviously, a higher price would encourage capital expenditure on exploration and additional production. And again, this is speculative, of course, because it depends on each individual operation. But where do you see prices need to be to make it in Canada, to have things make sense for Canadian oil production generally? Just talk a little bit about that and how you guys look at that from your perspective of a royalty company, and whether it works or if it doesn't work.
Yeah, every $5 to $10 drop in oil is going to create a material shift in activity levels in the basin and the drilling aspect of the industry. We see very big differences also in terms of the play type, as you referenced. And so to kind of point out some of the differences that you'll find up here in Canada is that different parts of the basin have very different oil qualities, and those oil qualities are then reflected in the net price received for oil. And so a term that is often used is light oil as compared to medium oil as compared to heavy oil. So light oil is going to be the highest valued type of oil, and that is going to have the lowest differential to the price of WTI. Medium oil would have a slightly higher differential and then receive a net slightly lower price than light oil. And then heavy oil would be the largest differential to WTI and the lowest price realization out of those three general categories of oil. So, we will see activity levels slow broadly if oil dropped below 60, and then we would see activity levels pretty much slow down to maintenance levels, I would call it, with oil going below 50. Now, again, that will vary across the play types. And so light oil having a higher price realization, and then with the FX component that we talked about, that will allow activity on light oil properties to sustain itself longer. That differential on heavy oil does squeeze margins a little bit quicker. We have seen the differential on heavy oil come down in the last year. That was the result of the Trans Mountain Pipeline coming online. So if we look back to this time in 2023, the differential on heavy oil, was in the $19 type range to WTI. Today, it's more in the $11, $12 type range. So, we've seen that differential on heavy oil lessen, and that's creating a better margin profile for the heavy oil projects. But again, if WTI dropped, those margins will still get squeezed quicker on the heavy oil projects, and ultimately companies are not going to continue to robustly drill projects where the rate of return is getting materially squeezed by the price of oil. It will become more of a maintenance type drill program approach where companies are drilling wells to continue lands. Companies are drilling wells to offset declines partially, but ultimately they wouldn't be looking to create growth in their assets. For sure, under $50 WTI and under 60, we would definitely see activity levels slow quite a bit. But from a macro standpoint in Canada, oil prices are quite strong still here today with oil in the 60s. Again, because the differential environment has been helped with Trans Mountain Pipeline coming on last year, and the FX dynamic is really material with the Canadian dollar weakness driving up the price realization from what is seen on the screen as a US dollar a WTI price point.
Brad, I really appreciate you covering those additional points there to give a context and flavor for the audience and how this is being looked at, as well as some of those dynamics that are specific to the Canadian oil production as well. Well, why don't we jump in here to Source Rock? How about just a quick overview of the company to get started? Give us a little bit of history on the company, Brad. What led you to start it up? Because you are the founder, of course, and then we'll get into a few details from there.
So as I mentioned, we have been around as a company for coming up 12 years, and it was derived from my intrigue to be an entrepreneur in oil and gas, but wanting to make sure that a business that I started was going to be sustainable and scalable, and not be a binary event for investors in the sense that we either succeed or we fail. And to me, it was more I wanted to build something that we could get going on day one, have a cash flow component to the business, and then be able to scale that cash flow going forward in a material way without having to continuously grind that cash flow by building out, I'll call it infrastructure to manage the business. And so royalties to me were extremely intriguing, that I had a bit of exposure to them through my legal practice. And at the time, there was really only one public company that existed as a pure play oil and gas royalty company. There were a couple other smaller family owned private groups. And so to me, it was a very uninhabited sandbox of opportunity that I thought would be welcomed by the investment community. And so we started this really with the idea that it was going to be a small little business that acquired cash flowing royalties and continuously built up that cash flow profile. And then as we got going, we found that this sandbox of opportunities was even larger than we realized. And so we quickly tried to, invest capital to scale the business faster than we initially envisioned. And so we did our first transaction in March of 2013. That was a small royalty doing approximately $10,000 a month of revenue. So we were cash flow positive month one with no G&A costs associated with the business at that time. And then from there, we just found more and more opportunities. And then we effectively issued equity to then be able to fund some of those opportunities. So then in total, we have completed over the course of those 12 years, $43 million of royalty acquisitions. And those types of acquisitions certainly vary in the sense that, we've acquired existing royalty interests where we've purchased that royalty from a third party owner. And then we've also over time become a source of capital to the industry where we provide capital to an operator that already has assets. They grant us a royalty in those assets and then use that capital to drill wells on the lands that we've just acquired the royalty in. So it's become a multi-tiered approach to acquiring these royalties over time. Again, 43 million of acquisitions completed. That has set us up where we've now had 12 years of being cash flow positive. And so we have never had a quarter in the history of the company that wasn't cash flow positive. And so that really, kind of highlights that, on day one, we viewed this as a sustainable and scalable business that could always be cash flow positive. And that has effectively played out over the history of the company. And so we were private for 9 years implementing this strategy. We were finding, though, that our deal flow was greater than our efficiency of access to capital, in the sense that, we were finding opportunities through our relationships in the industry. Sometimes these opportunities would have a fairly short fuse to them, and we wouldn't be able to access the capital fast enough to then execute on those opportunities. So then in 2022, we decided to go public, and we did a full prospectus IPO on the TSX Venture Exchange and raised just under $13 million of net proceeds to ramp up our acquisition strategy with now efficient access to capital. As we went public, we found ourselves in a very different oil price environment than when we started that listing process. And so we then hunkered down in mid 2022 when oil went up to all-time high Canadian dollar price levels of $140 or higher, and we held on to our cash, and we were benefiting from the acquisitions we'd done in the 9 years prior. Our production was hitting all-time highs, our revenue was hitting all-time highs, and we just sat on our cash balance for the majority of 2022. We then found ourselves late 2022 in a more normalized oil price environment in the 70s, and that is when we started our acquisition strategy as a public company, and we executed on $16.5 million of acquisitions from November of 2022 until December of 2023. So that is kind of, again, a summary of the history, both from a strategy and an execution of acquisition standpoint. And I think it's important to highlight as well that this strategy has always been focused on a balanced growth and yield approach to the business. So, I just highlighted kind of the acquisitions that, led to our portfolio and the growth in our business. But it's also important to point out that along the way, we consistently paid a dividend, which we started paying in Q1 of 2014. And we've paid dividends consistently to today, with the exception of 2 quarters in 2020 when COVID happened, where we paused the dividend.
Good history there, Brad. I appreciate that. And certainly interesting times there in the 2020-2021 period, as you well know. The quick drop in the oil price there, and of course the subsequent return once some sense came back into the market. So I'd like to get into some specific highlights of some of the royalties in the portfolio in a moment, but let's talk a little bit about capital structure. Cover where we stand presently today with the current cash on hand, Brad, the shares outstanding at the company. It is a very tight capital structure. Then, of course, major shareholders on the roster and how you and management are aligned with the shareholders.
We have 45.5 million shares issued and outstanding, all common shares. So very simple structure. We have no warrants outstanding, and we have incentive securities outstanding for board and management. We don't pay our board any cash fees, so our compensation tool with them is through incentive securities, which obviously increases their alignment with the business. That nets us 49 million shares fully diluted outstanding. Very strong alignment from an insider perspective. I own 5.5% of the company as the founder. Combined with other board and management, we own 10% as an insider group. We then have a 20% institutional shareholder, which is CN Rail Pension Fund. They are one of Canada's largest corporate pension funds, and they have been involved in Source Rock since July of 2014. They have participated in every financing that we've done since July 2014 and continue to be very supportive of us as a group and of the business approach that we're taking. It's very important to point out that from an alignment standpoint, we have no other motivation than to create value for shareholders, because we have the same cost per share as our current trading price as an insider group. And that is because on day one of creating this company, there was no founders shares issued, so there's no cheap shares outstanding. I went straight in with everybody else on day one and wrote a hard dollar check. I wrote a hard dollar check in every financing that we did throughout the last 12 years. And so there's very strong alignment there. That includes CN, who has an average cost of right around 90 cents. And so with our share price today, trading at 86 cents, again, as an insider group and our lead shareholder there, we have very direct alignment from a cost of our shares standpoint. And that's reflected in, what's happened since we went public, in the sense that, we've been listed now on the TSX Venture for over 2.5 years, but there has not been one share sold by an insider over that time. And there has been consistent buying of small tranches through our insider group in the open market. So very committed and aligned as a management and insider group. And from a balance sheet standpoint, we run this business very prudently. So we have never used debt in the history of the company. We've always funded our acquisitions through issuing equity, typically in advance of the acquisitions, but sometimes concurrently with acquisitions. And then we've recycled free cash flow as we've deployed that capital and then benefited from the revenue and cash flow coming from those newly acquired assets. Currently, we have 4.5 million of working capital on our balance sheet. That is approximately 10 cents per share, and that is more than 10% of our market cap currently. So quite a healthy cash balance that we'll be looking to use to deploy on new acquisitions and compound growth for existing shareholders. I mentioned our dividend earlier. So again, our dividend over time has transitioned from a quarterly dividend that we paid for 25 consecutive quarters prior to COVID. That was a 1.5 cent per share quarterly dividend. Again, we paused that dividend for 2 quarters during COVID and then reinstituted the dividend late in 2020. Then paid that quarterly dividend for all of 2021, all of 2022, and then Q1 of 2023 as well. Then in April of 2023, we transitioned to a monthly dividend. Now, having been a public company for a year, we felt that the monthly income from our business model would be more appreciated by our investor base. And when we transitioned to a monthly dividend, we also increased the dividend by 10%. And that was again April 2023. And then we subsequently increased the dividend again in October 2023 by 9%. And April of 2024 by 8%, to get us to our current monthly dividend of 0.0065 cents, which is 7.8 cents per year. And that is about a 9.2% yield on our current share price. So a healthy dividend. That, though, has been a very conservative payout ratio over the last couple of years. We're typically falling on an annual basis in and around a 60% payout ratio. Our internal mandate is to kind of be in a 50 to 70% payout of free cash flow range on our dividend. So again, very clean balance sheet, very prudently run business, very aligned insider group, and positioned with our cash balance to compound growth for existing shareholders, and at the same time provide a very healthy yield through the monthly dividend.
Lots of good information there, Brad. I appreciate it. I think it is quite attractive where things stand today for the company and how you guys have set up this capital structure. It's not your normal capital structure that most people are used to looking at when they look at and evaluate a Canadian junior company. So I appreciate how you guys have set this up. There's been a lot of thought behind it, and the alignment is certainly there. And on the yield, thank you for covering that. Monthly dividend is a really good setup. Just talk a little bit more about that payout ratio. One of the things at your office, something that you guys constantly probably battle over, would be determining how you deal with the payout of the dividend, supporting the sustainability of it, but then also potentially increasing it over time. And then also how you guys look at coupling that available cash flow for growth opportunities and what makes sense on that front to generate maximum value for shareholders. That's always a very difficult balance. And then obviously coupling that with oil price movements out there and how that can impact the cushion as well. Just talk a little bit about that, how you guys balance that out. You look at the dividend, how you look at the growth opportunity deployment, and obviously with where oil prices are today, that maybe there's better opportunities out there to look at that you guys would be more willing to look at pulling the trigger on at current prices rather than higher prices. So just talk a little bit how you guys deal with that balance.
Yeah, and as I mentioned, our approach has always been a balanced growth and yield business model. And Q2 2024 was a record production quarter for us of about 250 BOE per day, 95% oil. But again, at the same time, we've been paying this dividend consistently over a long period of time. And so, we are always pursuing a balance of the growth and providing that yield. We don't feel like our shareholder base ever wants us to shift too far to either side of that, in the sense that we don't want to be paying out 100% of our free cash flow and having no retained capital to do transactions with, and we also don't want to be fully focused on growth and not be providing our shareholders with a yield. Because again, the royalty business model is a cash flow business, and that cash flow should be balanced between returning capital to shareholders for the yield component of their portfolio, because that is typically why shareholders look to invest in a high cash flow royalty type model, is to get a yield. But again, at the same time, our business wants to be growing, and so we are, again, for lack of a better term, striking to achieve a balance from a year to year basis, where we're not missing opportunities because of the dividend, but at the same time, we're not losing shareholders because we don't have a dividend. And so, again, I think it is a balance. Ultimately, to your comment about oil prices and where opportunities present themselves, we certainly do find that the $60 to $80 WTI price range is a healthy environment for transactions. And so ultimately, in that environment, ultimately we're having an oil price realization dynamic that is going to move up and down. And so we are just typically on an annualized basis ensuring that our portfolio of royalties is not shifting our strategy too far or too far away from any component of that balance, growth and yield. And so I think we've achieved this balance over several years now, and I think that we will just continue to look to strike the balance on an annual basis and make sure that, again, the opportunity set we're getting through our relationships is niche, in the sense that it's not something that we typically can't do without with our existing balance sheet. And so as much as we now have a public company platform that we could raise capital through, our number one goal is to be utilizing our business and the cash flow from our business to be achieving the growth that we want to achieve, and providing that yield component. So, again, we'll have to navigate the ups and downs of oil prices and make sure that that balance is achieved on an annualized basis. We don't get too fixated with the ups and downs on a quarterly basis. And again, if anything ever skews outside of that range on either side, from too much of a yield and no cash flow left over for growth, or we're finding we're missing growth opportunities that are really attractive because of the yield, then we'll obviously have to navigate that. But for the time being, we're going to continue to be focused on that 50 to 70% payout of free cash flow, and that should allow us to have a decent amount of retained free cash flow to deploy onto new acquisitions.
Brad, thank you for that and how you guys are approaching this critical balance. With respect to if there was an opportunity, again, speculation here, so I appreciate any comments you can provide, but if there was an opportunity that came along that was a very good opportunity for the company that helps on that growth initiative, and you guys looking at where you are with cash flows coming in, current cash balance, and of course payment of dividends, would you consider looking at equity financings in the future to support those acquisitions when they make a lot of sense, or generally do you guys refrain from that?
Our goal as a public company and listing on the TSX Venture was to have more efficient access to capital through the public markets, to allow us to efficiently and quickly execute on larger transactions beyond just our balance sheet. We found ourselves in a dynamic now where we have, again, just to refresh, we listed the company through our initial public offering at 90 cents. Today, we are trading at 86 cents, but we have grown the production base of the company by 40% or more. We've grown our royalty lands by approximately 100%. As I mentioned, we've increased the dividend 3 times for a 30% increase. And we've importantly really diversified the asset base, both from a proved producing asset profile. So our existing production is much more broad. And we've increased the undeveloped land exposure, which is important for ongoing drilling activity and growth in the future. Yet, our share price is flat to slightly down despite achieving all that growth. So we are arguably trading at the lowest valuation in the history of the company, despite achieving this growth. And so although we've created a listed company platform that allows us to more quickly access capital, so efficient from that standpoint. We've now found ourselves with very inefficient cost of capital. And so our goal is certainly to not issue equity at the current share price. We don't view that as the right strategy long term to grow the business. Ultimately, we want to achieve a better valuation on our existing asset base. We want to focus on compounding growth for existing shareholders through our cash balance and recycling free cash flow. And if at some point in the future we find a very attractive acquisition opportunity and our share price is more accurately reflecting from our perspective a fair valuation for the assets that we have, then certainly we would look to utilize the public company markets and the listing and the efficient access to capital in that sense, as long as it was efficient from a cost of capital standpoint as well. Because again, the business does not need to issue equity. We've created material growth through our IPO proceeds and recycling free cash flow. Again, for reference, we raised just under 13 million of net proceeds through our IPO. We've deployed $16.5 million since our IPO, and we haven't done a transaction in 10 months, yet we're achieving all-time high production. And so, the business is very strong, very sound. We do not feel that the current share price is reflecting fair value for the assets. And so we would refrain from issuing equity at the current level and look to, again, continue to grow, continue to compound, strive to get a more appropriate valuation reflected on the business. And then ultimately, if at some point in the future that more appropriate valuation is there and we have a robust opportunity set in front of us, then certainly utilizing the public listing and efficient access to issuing equity would be something that we would look at. Again, only in this circumstances where we're accretively growing the business and having a fair value reflected on it. We do not believe that we should be getting on this hamster wheel of issuing equity, doing transactions, the share price staying flat or going down, and then issuing more equity to do more transactions. We don't want to grow at all costs. We don't want to grow for the sake of growing. We want to grow prudently, and we want to try to maximize value for existing shareholders.
Brad, a very good response here, very intelligent on how you put this. Appreciate that and how you guys are looking at this very much in a way that we would look at it as well. And I think as time wears on here and you guys continue to demonstrate the effectiveness of the company and your guys' management expertise, that the market will start to appreciate what you guys have put together here, which is quite interesting and compelling where it sits today. Just one other thing that is not necessarily on the cap structure, but more along the lines of management team. It's a fairly small management team. You guys run a pretty lean operation out there as, of course, a royalty company, generally small staff. But just talk a little bit about the key people at the company that are supporting you and what they bring to the table.
Yeah, absolutely. So we definitely have a small team. I am the only full-time employee after 12 years here still. So day to day, it's just myself, pursuing the business growth and running the business on a day-to-day basis. We do have a very key resource in our CFO though. So she is a consultant. She is working part-time for Source Rock, but definitely a very seasoned resource in the sense that she has extensive upstream oil and gas experience. She was a accountant, professional accountant by background. She's worked as a research associate at an investment bank in the past. And so again, managing the day-to-day bookkeeping, record keeping, financial records, producing financial statements is her focus. But again, not a full-time employee of the business. So that allows us to, again, manage the cost structure side where we have, extremely seasoned, valuable CFO fulfilling that role for us. But again, not having to compensate her like a full-time CFO, which obviously is valuable and beneficial for shareholders. We then have a corporate secretary who is not your typical corporate secretary in the sense that he's very engaged and involved in the strategy of the business. He has been involved since inception. Very, very intelligent corporate securities lawyer that helps in all aspects of strategy and again, not only facilitating the flow of paperwork associated with our deals, but just our public company compliance and ongoing strategy approaches as well. So he's at Denton's Canada, which is one of the largest law firms in the world, I believe. So a great resource for us there. We then have a technical advisor that we work with very closely. This is Trimble Energy Group. Trimble has been a reserve evaluator and advisor to the oil and gas industry for greater than 50 years now. They're Calgary based. And so they have become a growing importance in our business in the sense that, we don't have a technical team day to day that we staff. Again, from the cost management side of the business, it would get quite expensive to have a geologist and an engineer on staff full time. And so we've really begun to utilize Trimble more and more as we build out the relationship with them, in that they don't only evaluate our assets annually from a reserve perspective for our public company filings, but they've become more and more involved when we want them to be on an evaluation basis from acquisition to acquisition. And so they're very efficient in terms of how quickly they get very thorough technical work done for us. And it's very cost effective for us as well to utilize their team, which is a very in-depth team of engineers and more geological focused technical personnel. So great resource for us. Again, allows us to not staff a full technical team, but get that level of evaluation completed efficiently on an acquisition by acquisition basis. On the surface, you look at the size of our company, and then you look at the size of our board, and you kind of wonder why we have so many people on our board. But it is really by design, and so we are the only junior oil and gas royalty company listed in Canada, and so with that, we have a niche opportunity in a space that has very few players to pursue acquisitions that are either not moving the needle for our larger peers that we do have, but are just not being pursued in general. And so we find those opportunities through our relationships as a group. And so our board of directors was, again, created strategically to not only help facilitate access to niche transactions that we are pursuing on our own. That is largely derived through the two landmen on our board. There's Sean Thiessen and Scott Rideout. But then we also very strategically have technical personnel on our board that can act as a technical backstop on vetting transactions. Again, these smaller niche transactions, again, don't necessarily need a Trimble to evaluate them all the time. We can efficiently look at them with the technical lens of our board as well. And so we have, again, two landmen, two geologists, an engineer, and two accounting professionals on our board. They are very engaged as a group. They have a lot of tenure in terms of their length of involvement in the company, goes back to inception. And so we have three directors, Gary, Scott, and John, who have all been involved since inception. We then have Jordan Keevil, who joined our board in 2014. Sean Thiessen joined our board in 2015. He was the lead landman on the spin out of Prairie Sky Royalty from Encana, and then subsequently left there and joined our board. And then Dean Potter joined in 2017. And again, to my comments about technical expertise, Dean is a 45-year geologist. He is in the Oil and Gas Hall of Fame in Saskatchewan, very renowned for the discoveries that he's made. And so he does provide us with that very seasoned technical lens, again, that he can participate in evaluating assets with. June Marie was our most recent addition, very seasoned accounting professional, executive that, again, is very tapped into the capital markets and the oil and gas industry in Calgary. So, again, small group in terms of day-to-day personnel, but very strategically built team to allow us to manage costs on a day-to-day and month-to-month basis, keep costs low to drive cash flow for shareholders, but still position us with very in-depth relationships to tap into niche deal flow and to be able to evaluate transactions efficiently at a board level and with our advisors.
Let's talk a little bit more about the high-level royalty projects that you guys have in the portfolio, royalties you guys have just added, and of course, any others that you want to highlight. There's quite a bit in the portfolio, actually, but give us a little bit here as far as, I know you can't give up the secret sauce, Brad, but just a little bit on how you guys evaluate these royalty acquisitions if they make sense, what are some of the key metrics that you guys look at, say this is a good deal or this is not a good deal for the company? And maybe we can use one of those projects in the portfolio as an example as to why it made sense for the company. Maybe we can use the Clearwater heavy oil gross overriding royalty as an example, but just talk about some of those key royalties and how you guys approach that evaluation based on one of the projects that's recently been added.
So I'll start off just by touching briefly on, I guess, the concept of, well, what are royalties and why do we enjoy owning them, and what are the benefits, and then I'll kind of work my way down to, talking about the opportunity set and the specific Clearwater transaction. So, for us, oil and gas royalties are very strategic, and they're strategic in the sense that, we own these royalties, which are classified as interests in land. So our interest is attached to mineral rights or derived from mineral rights if we own those minerals. But we don't operate the lands at all. We don't pay for drilling associated with producing from the lands. We don't pay for optimization costs. And longer term, we don't have any exposure to the abandonment liabilities, reclamation costs. And so that really allows us to have this platform that we've talked about, which is a low cost platform that owns these assets, very simple in terms of, a day-to-day business and a day-to-day portfolio of assets to own. So that really allows us to have this inflation protected platform. We buy these assets, we own these assets, we benefit from the production and revenue derived from these assets without any future costs. Now, again, importantly as well is that, we have approached our business as being an oil-focused royalty company. That to us has positioned us to be able to drive profit per barrel. And so we benefit from the royalty production being a top-line revenue stream. And what that means is that when oil is produced from our royalty lands and sold in the field at a price, call it $90 Canadian, we then receive that $90 Canadian price. We have minimal exposure across our portfolio to any of the costs associated with producing from these lands. So an operator will typically have the $90 oil reference price, and then they have all the costs associated with producing from the lands, paying royalties to groups like ourselves and the government, and then ultimately they have a net price. So our business model is set up where we have effectively majority of our assets being top line revenue. Top line revenue is, again, the beneficiary of the field price received, and that is driving net back for our portfolio, and net back being profit per barrel of production. So I think that's just kind of a quick landscape on, these royalties are interest in land, which is important to point out that we're not attached to the balance sheet of the operators that produce the lands. Our royalty stays attached to the lands as the lands change hand over time. And ultimately, again, we just don't have the cost exposure to drill the wells, which is really, again, allowing us to have this simple operating platform to own these assets in. So then in terms of, how do royalties come about, and how do we approach our acquisitions? So, royalties can be derived from lots of different approaches, and there's a couple of key ones that I'll highlight those. So royalties can be derived from owning minerals, and then those minerals are leased out to an operator in exchange for a royalty interest. Royalties can also be contractually created and attached to leases that are already existing. And so we have ultimately taken a broad approach to our business where we're acquiring existing royalties. Those existing royalties could be derived from farming out mineral interests, or they could be derived from a royalty being granted on leased mineral interests. And we would purchase that existing royalty from the third-party owner. In those instances, we would not have a direct relationship with the operator in terms of, having intel as to what they're going to drill and when they're going to drill it. So we would be buying those existing royalties purely on the basis that we like the existing production that's coming from the lands. We see some upside potential. Don't know when that upside potential might get captured, but we're confident from a technical perspective that there's upside there. Now, that's very different than the other angle that we've been taking in our business, where we are effectively creating partnerships with operators providing them with capital, and in exchange for that, they grant us a royalty in certain lands that they already own, and then they commit to ongoing development associated with those lands. Now, for us, that has been beneficial because it has allowed us to balance the ongoing growth of not only our existing production, so we attach a royalty to assets that the operator has that are already producing. We're also attaching that royalty to the undeveloped land associated with those assets. And in most instances, we're getting drilling commitments from those operators to create growth and create ongoing activity on those lands, which really kind of allows us to have good line of sight to, again, not only day one where we create increased production through the transaction, but ongoing growth and drilling happening on the lands gives us visibility to what, again, it might come in the future from those royalty lands. And so that has been beneficial for us because it creates that balance on day one, where again, not only are we growing existing production, we're growing our undeveloped land portfolio, and we're getting commitments from operators to drill those lands in the near term to create a growth wedge associated with our business. Now, for the operators, it's really become a beneficial strategy as well, in the sense that capital has become scarce for the junior oil and gas industry, with debt largely becoming unavailable, or smaller companies don't want debt because it's risky from a balance sheet perspective. Those relationships between lenders and junior oil and gas companies have become very strained. At the same time, equity valuations have become or have gotten to low levels and stayed there now for an extended period of time. And so issuing equity, if it's available, is very dilutive. And so royalty capital, as I'll call it, where we provide capital to an operator in exchange for receiving a royalty in certain lands, that has become a very mutually beneficial approach to for operators to access capital, where they are effectively selling us a piece of the asset in the form of a royalty. We become a very vested partner in that asset. It's non-dilutive for them. There's no handcuffs like debt. And then they have a partner going forward that wants to see that asset successfully developed as well. So that again kind of lays the landscape of what are royalties, what opportunities do we see. Now, I've referenced our approach, and our approach is really derived from creating that balance. I've referenced balance, growth, and yield throughout our conversation here, and you can see that reflected in the types of transactions that we're pursuing as well, where we're always trying to balance the growth of the revenue profile today, but also balance or create greater exposure to potential growth in the future. And so that increase to existing production on day one really backstops the yield component of our business. The exposure to undeveloped land and receiving the drill commitment then creates that visibility to a growth wedge for the portfolio on an ongoing basis. So again, I think that really reflects our strategy, that reflects the opportunities we see. Now, from a valuation standpoint and how do we look at deals, that really does vary from opportunity to opportunity. That is going to vary dependent on how much proved producing reserves are there, how much undeveloped land is there, and what is the likelihood that undeveloped land is going to get drilled near term, what is the decline profile on the existing production, who is the counterparty operator, what is their balance sheet look like, do they have the ability to execute on a growth drilling plan associated with the lands. And so it is really hard to just generically say, well, here is kind of the valuation we're looking to get to on every deal, because there are lots of variables that go into it. Some of them very specific to the technical aspects of the asset, but as I just mentioned, some of them more intangible in terms of the dynamics associated with the operator that we would be partnering with, or the operator of the lands in a situation where we're just acquiring existing royalty.
Hopefully the audience took some notes on what you said there. I think that some of the points you made are quite important on how you should also look at these from an investor standpoint in our audience, and how they would approach evaluating some of these assets as well. Of course, lots of different components, cost profiles, declines in production, the continued development of well fields, obviously in the areas of which you hold the royalties. There's a lot of different things going on here, and how you approach these different components and how those come into the overall evaluation. So I appreciate you touching on the high level end of this as well. You mentioned some of the counterparty operators and the importance of that. I want to have you just talk a little bit more about that. You guys have groups, operator counterparties out there such as Whitecap, Anova, Vermilion as well. These are just some. There's a lot more out there that you guys are working with. Of course, the audience can take a look at some of the other operators you're working with and some of the company materials that you guys have available. But talk about the importance of a good operating counterparty, because obviously their operations and their abilities really result in the best bottom line for you guys as well. So just talk a little bit about that importance of a good operating counterparty.
Yeah, the importance can't be overemphasized in the sense that, we do not have any control over the field operations that happen on our lands. And that includes optimization and maintenance of existing production and the execution of drilling and growth in the future on the lands. So, that is a very, very key characteristic of our approach to our business, in that we would not ever be looking to acquire a royalty in lands that is operated by a company that we feel has issues or problems, or is not acting in good practice or in the right ways in the field. We are looking to acquire royalties in lands operated by top tier companies that are, again, operating with good oil field practices, have a clean balance sheet, have strong proven management, and that have a history of creating value for their own shareholders. Because ultimately, if that operator is creating value for themselves, ultimately, and we have exposure to high quality lands within their portfolio, then we are effectively benefiting from that value creation as well. And so, our portfolio does have a fairly diverse set of operators at this point. Our key operators, just in terms of the quantum of their revenue associated with the royalty lands that we have with them, Whitecap, Rubellite, Surge, Anova, Axiom. A couple of those companies are private companies. A few of them are more well-known publicly listed companies. But I think as a whole, they're very healthy companies with high-quality management teams that have a history of creating growth and executing, and they always operate with good oil field practices in mind. And so again, that is our focus, and that's reflected in the approach we've taken over the last couple of years. Since we listed on the Venture Exchange, we've done 2 transactions with Anova, which have gone very well. Those are both Southeast Saskatchewan transactions that had material drill commitments that they executed on very efficiently. And then, as we talked about earlier, we did a Clearwater transaction back in December. That was with Rubellite Energy. That was an $8 million transaction where we attached a royalty and were granted a royalty in 95 sections of Clearwater lands, largely contiguous. And that had 2,800 barrels a day of existing production on the lands. And Rubellite undertook to drill 59 wells on those lands over a 2.5-year period from when we closed that transaction. So again, that is reflective of the high quality nature of the counterparty that we want to be dealing with, in the sense that Rubellite is a very successful group of oil and gas professionals. They have very strong relationships in the capital markets. So we're not solving a problem for them in terms of them needing to do a royalty transaction to fix their balance sheet. We are providing a source of capital that's supplemental to their other sources of capital within their capital stack, and they're utilizing our capital to help ramp up operations on the lands in which we're receiving a royalty. So again, we want to be dealing with these strong operators, not be dealing with operators that are looking for a solution through granting a royalty, and nor do we want to acquire an existing royalty that has an operator that's not going to be able to execute on any future growth, or is unlikely to do a high quality job of maintaining the existing production profile. So we really do take a top down approach to evaluating the assets. It's not just a technical evaluation. It is, who is the operator of these assets going to be, and would we effectively want to invest in that operator? Because we indirectly are, right? We're buying an interest in an asset that they're going to operate, and so we need to have confidence that they have the right management team, a strong balance sheet, good oil field practice history, the ability to execute on top tier maintenance of existing production, and execution of a drilling program going forward.
Thank you for that. And yeah, I believe there's somewhere around the neighborhood of you guys have about 20 royalty payers that make up nearly 100%, not quite 100% of your guys' total royalty revenue. So I appreciate how you guys look at the counterparties. Two follow-ups there, Brad, that I have that came up as you were talking. One thing is you look at different deals and the way they're structured. My first question is, would there be an instance where you guys might consider, as part of a royalty deal, also looking at equity in some of these operators if they meet your guys' requirements? Would you look at equity as part of a deal there? And then also, secondly, you guys are now having record amounts of revenue come into the company. Give us just some kind of a future look as to how you see that revenue ramping up in the years to come. I know it's subjective, and of course, you guys have more projects coming online, but just talk a little bit about how you see that profile looking. If you can give us a picture of how it continues to grow, if it levels off, just give us a little bit on that as well.
The first question there, equity ownership is not part of our current strategy. So just a quick answer there. I mean, we are looking to build out our royalty portfolio only, and we would not be looking to also acquire equity in any company or our counterparty operators. So, yeah, we'd like to keep our asset portfolio clean and scale the amount of royalty lands that we have, and that would include both from an existing production scale standpoint and an undeveloped land scale standpoint. So then the second part of the question there, so I'll say first and foremost, we don't have a production forecast or a revenue forecast in the market as a royalty owner and a party that's not involved in the operations in the field. We don't dictate the timing of drilling. We don't dictate the optimization efforts of existing production, and so it is really challenging to forecast when and how much production are we going to receive from our royalty lands. And then adding to that is the oil price dynamic that, as we all know, is continuously extremely volatile. And so, we have avoided and will continue to avoid trying to issue forecasts simply because we don't want to mislead anyone on either side of that, because, again, we don't have those controls from a timing perspective or a price realization perspective. Having said that, again, our approach to the business is that we're continuously looking to diversify the existing production profile, which will, create steady, long life existing production. Again, at the same time, we're looking to expose ourselves to ongoing drilling that has, foreseeable likelihood in the near term. And as you mentioned, we have had some transactions done recently where there's, drilling commitments associated with those transactions. And so, again, I'm not going to give you a forecast or guidance here, but I think in generality, I just want to emphasize that, we have a portfolio, and within that portfolio, there are certain assets that are, low decline, long life assets that aren't going to grow. Within that portfolio, we also have assets that are more heavily declined assets that, again, they're declining from this point forward, and some of which will decline materially. And that is part of the portfolio. And then we have our higher growth components of our portfolio where there's existing production, strong, identifiable drill locations, and those drill locations are largely going to get drilled at the timeline that the operator sets. Now, having said that, we do have the transaction with Rubellite that we did in December of 2023, where that transaction had a 59 well drill commitment that was required to be executed between December 2023 and June of 2026. Rubellite has been, somewhat methodically executing that for this year. They've now executed, as far as I'm aware, to the latest data that I have, 9 wells of those 59 wells. So that leaves 50 additional wells that could potentially get drilled between now and June of 2026, which is quite material. And so, we do expect that Clearwater property to create growth. But as I mentioned, the rest of the portfolio does not have a specific drill commitment associated with it at this point. And so then that would have a balance of things going on. And again, those things being declining production from existing assets. That decline ratio is going to vary from asset to asset. And then there's going to be ongoing drilling that happens on our lands at the pace that the operators dictate. And so ultimately, it is a balanced approach to building a portfolio that has, again, not only long life production, not only high decline new drills, but a balance of all of the above so that hopefully we can have a consistent, modestly growing portfolio over time. And obviously, with our cash balance, we're continuously looking to grow that producing part of our business, the existing production part of our business, and continue to expand the undeveloped land part of our business that will lead to more drilling as well. So, again, in summary, very difficult to provide a forecast, and I'm not going to venture to do so. But we are continuously trying to take a portfolio approach to building our business to make sure that we don't have just a high decline portfolio or just a low producing portfolio that's dependent on execution of certain drilling in the near term. We always want to be trying to balance all those factors in the types of deals that we're doing.
That is good information to hear. And I think folks can spend a little bit more time and look at some of the company materials and filings to put together a little bit more of an understanding about the timeframes that we're looking at and also the history of the company and the performances thus far with respect to management of the royalty portfolio and making sure that there is definitely growth and handling of declining royalties and those types of things as well. Brad, just on another note here, another thing that came up as you were talking, and I was looking at various things over here on the listings. You guys have a venture listing, and of course, you guys have had a venture listing since the IPO. Talk a little bit about any desire at the company to add a US OTC listing, Brad, in the near future, or if that is not of interest at this point.
Yeah, so it's something we're looking at and considering. I would say there's no clear path as to whether it will happen or not at this point. I think it's interesting in terms of how the OTC QX and OTC, I guess, in general, but we'd be looking if we did do it at an OTC QX listing. It's really broadened over the years in terms of having paths for Canadian companies to not only list, but to then expose themselves to a strong potential investor base in the U.S. And so, for us, it's in the early innings of being evaluated. The key to doing it for me is that if we were going to undertake the listing, then we would certainly want to have comfort that there is a marketing plan in place that would have a high likelihood of success, and success being, getting exposed to an investor base that is interested in not only Canadian oil and gas, but Canadian oil and gas royalties, and in companies that have a 40 million or so market cap. And so that is kind of our ongoing evaluation. Is it the right type of product to expose to the U.S.? What's the likelihood of getting traction, expanding our shareholder base materially into the U.S. through the listing? Because we certainly don't want to undertake the listing and then just sit back and see if anyone in the US buys it. It would certainly be a process of looking to expand the audience through the US listing by undertaking efforts to tell the story in that market. And so again, don't have any further guidance on that besides we're looking at it, we're considering it, we're trying to wrap our head around the process and what the follow on approach would need to be to really maximize the value of getting such a listing.
I think that's the right approach. Take a look at it, evaluate it. I do think that investor access continues to be a little bit difficult in the US, especially for US retail accounts. Getting into Canadian equities is a bit difficult from a US retail broker stance. So that US OTC listing, whether it's QB, QX, tends to be the best option and is definitely available with major brokerages within the US that are more retail oriented. So hopefully that makes some sense, but I'm not terribly familiar on current costs for that listing process, but maybe it will make some sense in the future as you guys look to expand some of the investor base as well, especially that demographic of investors looking for income within the United States, as well as that more retail oriented crowd. Just another question here on overall strategy, Brad. I always like to ask this to most of our guests, depending on what company and, of course, their condition. But how do you see the end strategy for the company, Brad? Do you see that this really continues to grow with no end in sight? Would management look at a certain point if valuation was proper and you guys achieve some of the internal goals? Would you guys look to sell out? How do you look at the long term for the company and that eventual exit strategy for yourself and for shareholders?
Yeah, so we, as I mentioned, are the only publicly listed pure play oil and gas junior royalty company. And I emphasize the junior aspect of that because being the small or the only small version listed in the markets is a niche opportunity for us in that, we have three other public company peers that are multi-billion-dollar entities. And so we do continue to pursue an opportunity set that is typically not big enough to move the needle for our larger peers, but quite attractive to us. And so, strategy approach number one is to continue to build out a diversified portfolio of royalties. We want to expand upon our royalty acreage. We have approximately 150,000 gross acres of land at this point, which again, we provided us with 250 barrels a day or BOEs a day, largely oil in Q2. And so that diversification has been happening. And we continue to have the balance sheet to undertake more acquisitions to diversify further. But as I mentioned, if the public markets are not providing a value to the portfolio that we're building that we think is appropriate, then we are going to be restricted to compounding growth through recycling free cash flow. And I think it's important then in that context to evaluate, what is in the best interest of shareholders, which includes myself as the second largest shareholder and CN Pension Fund as the largest shareholder. And how do we, again, maximize value for shareholders? And so we are in no way married to building this out for the long term. If an opportunity exists to crystallize value in a better way for shareholders, but at the same time, the business is set up in a way that we can manage our cost structure very prudently. We can maximize free cash flow for shareholders, which again is going to typically be returned partially to them through dividends and then partially used to compound growth. And so, I think it is really a strategy that's going to be dependent on, what market dynamics are we dealing with. And as we compound growth and diversify our portfolio further, are we getting, a value reflected in the market that we think is reasonable to allow us to continue with that strategy? Or do we feel like the market is undervaluing our portfolio and our business? And do we look to crystallize a value somehow for shareholders in a different way? And so, I think back to our original earlier conversation around capital structure and alignment. I think that ultimately we are comfortable in saying that we're directly aligned with all shareholders. Again, not having any cheap shares or anything like that. And so, we will always be open to doing what is going to create the most value for shareholders at any given time. And obviously the market conditions will kind of dictate what that is, whether it's a compound, keep growing approach, or whether it's looking at other strategic paths forward to crystallize value more quickly.
Brad, I absolutely think that's the right approach here, and you guys continue to execute on your strategy. See how the market responds to that is obviously the prudent course. And also any other special opportunities that come across the desk in the years ahead. Well, Brad, short of anything else you want to add here, why don't we leave it there for now? For potential investors who are listening in, the company has a market capitalization of about 40 million Canadian dollars. Why should Source Rock Royalties be considered within the institutional, family office, and retail investors portfolio at this stage?
Yeah, so after 12 years, we've really proven that this is a high cash flow business that can create material profit per barrel, that we can build out an asset base that continues to get more diversified and effectively drive all of that revenue growth to the bottom line and it translate into cash flow growth. And so, 12 years of executing on this business is a big milestone for me. And we continue to do so in the context of having this lead institutional shareholder, strong alignment as insiders. And, we have the business positioned where we are the highest yield in the Canadian oil and gas royalty space at greater than 9% today. We have the lowest valuation amongst our public company peers. And that valuation is, from our perspective, even lower than what we're seeing a lot of assets transact at in the private markets. And so we do feel like, there is a valuation re-rate that we can hopefully achieve at some point as we diversify further and continue to expose the company. We've driven now for many years an extremely strong netback or profit per barrel, which we think is an important metric. Again, for us, we're trying to maximize profit for shareholders, and in doing so, that is going to be reflected in that net profit per barrel on our royalty production. And I think importantly, we're positioned for growth, and we've continued to execute on that growth as a public company. Again, paying a strong dividend, but achieving record production in Q2, is an important milestone for us as well, and that we again are achieving that balanced growth and yield business model. We have a built-up cash profile now, which has gotten up to about $4.5 million this year, as we've held on to our free cash flow in excess of our dividend, and we're looking to deploy that cash balance on new acquisitions, oil-focused royalty acquisitions that are not only going to grow our existing production profile, but also our undeveloped land profile, which will then lead to future drilling and future growth. So again, our low-cost strategy, our low-cost approach to driving free cash flow has really played out consistently over 12 years. And we think that as we continue to compound and execute on this business model, that will just drive even higher cash flow margins for shareholders. And ideally, we're looking back a year from now and seeing a valuation placed on our business that is more reflective of market dynamics, and then that will allow us to continue to accelerate growth and have that portfolio approach to the business that allows not only top line revenue growth, but allows cash flow growth and allows strong yield return to shareholders.
And for those interested, Brad, what is the best way for investors and other interested parties to contact the company?
Yeah, so my direct contact information is readily available out there. My email is on our website, brad@sourcerockroyalties.com. My phone number is on our website there, both accessible at www.sourcerockroyalties.com. Certainly feel free to email me or call with follow-up questions. And I will point out that our website is a very strong resource in terms of information, both with respect to corporate presentation, historical dividend payment information. There's all of our news releases are on there, as well as various interviews and kind of coverage that we've had from a media perspective. And we'll certainly post this conversation on our website when it becomes available.
Brad, it was great to get an introduction to Source Rock. Best of luck in the coming months with objectives at the company. Looking forward to having you back in 2025 to update. Thanks for the time.
Thanks so much for having me. It was a pleasure.